Welcome, fellow shareholders, investors, and market analysts. We are jumping right into a high-stakes briefing today on Integral Diagnostics, ticker symbol ASX IDX. We're going to take a really deep, analytical look at the company's future market value as we move through what is honestly a highly transitional period in 2026. If you've been following the diagnostic imaging sector at all lately, you already know that Integral Diagnostics has been making some absolutely massive moves. We're talking transformative mergers, navigating some seriously complex regulatory reforms, the whole shebang. So, putting my analyst hat on today, my goal is to give us a crystal clear, structured view of the risks, the major growth indicators, and exactly what all these shifts mean for the bottom line. Let's get into it. Okay, let's dive into our roadmap for this explainer. First, we'll unpack the turnaround year, basically balancing that massive EBITDA surge against the underlying margins. Then, we're mapping out the crucial 2025 MRI reforms, the 2026 telehealth changes, and yeah, we'll tackle the elephant in the room, the upcoming leadership transition. Finally, we'll tie it all together with the long-term growth drivers and our final verdict. Starting with Section 1, the turnaround year. And right off the bat, we're faced with this fascinating tension between explosive top-line growth and the undeniable reality of tight operating margins. I mean, we just have to kick things off with this staggering number, a 76% EBITDA surge. During the first half of the 2026 financial year, Integral Diagnostics absolutely crushed it, delivering record performance across its earnings lines. And a huge chunk of this aggressive operational leverage, it was driven by the successful integration of the Capital Health merger. That move rapidly accelerated their market footprint and let them extract some really significant synergies. Now, what's really interesting is the full financial picture these numbers paint for us. Yes, we're looking at a wildly bullish revenue jump to $393.5 million. That's up over 55%, alongside a very solid 7.4% organic growth rate right here in Australia. But as an analyst constantly examining risk, my eyes go straight to the bottom line. That 1.8% net profit margin, it's razor thin. Seriously, it leaves almost zero room for error. It means that while the company is scaling beautifully, any little operational misstep or even an adverse policy change could heavily impact the cash they actually have available for reinvestment or, of course, shareholder dividends. And that margin reality brings us perfectly to Section 2, the July 2025 MRI deregulation. To protect and grow that tight margin, they are relying heavily on an incredibly favorable regulatory landscape. Look, the diagnostic imaging sector is fundamentally shaped by the Medicare Benefit Schedule, the MBS. And here is the timeline acting as a massive catalyst for their organic growth. Check this out. On July 1, 2025, the Commonwealth finally transitions from a restrictive equipment-based licensing system to a practice-based model. By November, the $8 billion GP bulk billing incentive program expands to all Australians. That drives up GP visits, which, as we know, are the primary referral engine for imaging. And then, subject to legislation, we're looking at full MRI deregulation by July 2027. To see exactly how this specifically benefits Integral Diagnostics locations, think about this. Literally overnight, on July 1, 2025, 16 of their partially licensed MRIs and 3 unlicensed MRIs automatically upgrade to become fully Medicare eligible. Just like that. This means those clinics can suddenly service specialist MRI referrals, not just GPs. It is a seamless, zero capex opportunity to snatch market share right out from under competitors simply because their existing machines are now totally unlocked by Medicare. It's huge. Alongside that deregulation, July 2025 also brings a 2.4% Medicare indexation applied to ultrasound, CT, and MRI items. Now remember what we said earlier? When you have a net profit margin of 1.8%, inflation is basically your biggest enemy. This 2.4% indexation acts as a critical, structural offset to clinical labor inflation. It actively protects the average fee per exam and essentially secures the company's profitability. But of course, the regulatory environment isn't static. Moving to Section 3, the 2026 telehealth changes. Let's look at the next wave of regulations hitting and how they impact service margins. We really have to contrast these two regulatory waves. The July 2025 imaging reforms, they are unapologetically pro-growth. They drive high-volume, high-margin MRI and CT capabilities directly to the clinics. But the changes rolling out in 2026, they're a bit more nuanced. Specifically, starting in March 2026, new patient end support items are being reinstated to improve support during telehealth consultations that involve more than one service provider. And honestly, this brilliantly illustrates why navigating the MBS is practically a full-time job. The Services Australia budget documents lay out these March 2026 telehealth restructures, which are actually reinstating some GP and nurse practitioner services that previously ceased back in 2022. For a vertically integrated provider like IDX, adapting to these super granular fee adjustments, knowing exactly which services get rebates and which ones have ceased, is absolutely essential. It dictates exactly where they deploy their clinical staff to maintain that delicate long-term profit margin.
All right, Section 4. As we assess future stability, we cannot ignore the impending leadership transition.
It's a question we have to ask. Whenever a company undergoes a massive merger and hits record revenues, only to suddenly announce a change in leadership, the market inevitably gets a little nervous. So, is this turnover a strategic risk that could derail the whole Capitol Health integration? Or is it a carefully planned growth opportunity, bringing in some fresh operational vision? The catalyst here is the announcement that Dr. Ian Kadish will be retiring at the end of FY26. First, we have to acknowledge Dr. Kadish's immense contribution. I mean, since 2017, he literally transformed IDX from a regional practice into Australasia's second-largest radiology network. And now, he'll be handing the reins over to Jason Martinez, who officially takes the top job in August 2026. So the crucial point for us as investors is how the board is actually managing this. Looking at the primary indicators of future stability, they seem to have engineered a highly de-risked transition. Dr. Kadish is staying on through an extended transition period right up until Martinez arrives in August 2026. Plus, they've fortified clinical governance by appointing Dr. Manish Mittal, who is a radiologist with 18 years at IDX, straight to the board. So they're pairing Martinez's extensive operational experience with deeply retained medical expertise at the governance level. And all this is happening while the heavy lifting of the Capitol Health integration is pretty much already complete. It's really a textbook execution of a stable handover.
Thank you for watching. Please like and subscribe to our channel.
So, with the leadership risk largely mitigated, let's pivot to Section 5, the long-term growth drivers. What's propelling this company through the end of the decade? The whole strategy relies on 3 structural steps that are, thankfully, largely independent of broader economic cycles. Step 1 is this deliberate modality mix shift. By pushing patients toward higher-margin, high-acuity diagnostics like PEC, CT, and MRI, they can way better amortize their massive fixed infrastructure costs. Step 2 is technological. IDX, which is their teleradiology business, now accounts for 15% of Australian revenue, ensuring crazy rapid turnaround times using AI. And Step 3 is capturing the incoming volume from the $264 million government-funded National Lung Cancer Screening Program kicking off in July 2025. That is going to drive massive growth in screening CTs and follow-up procedures. To put a fine point on that modality mix shift we just talked about, take a look at the Medicare changes to PET scans. From July 2025, MBS PET items are actually being expanded for the initial staging and evaluation of FDG-avid cancers. This perfectly aligns with IDX's deliberate shift toward high-acuity oncology diagnostics. It literally means more of their highest-margin services are now going to be fully backed by Medicare rebates. And that brings us to our final section, valuation and our final verdict. We've seen the 76% EBITDA surge, we know all about the regulatory tailwinds now, and we've assessed the leadership change. So how does all of this translate to actual market value? Let's pull this together into an executive summary. The shares are currently trading at a forward PE ratio of 60.1x. So yeah, the market definitely has some high expectations already baked in. However, the PG ratio sits at a remarkably low 0.54. That suggests that future growth might actually be underestimated right now. But the most glaring metric to me, the current share price sits around the $2.22 to $2.30 mark, while discounted cash flow models place the intrinsic fair value way up at roughly $6.39. Guys, that is a massive margin of safety and implies some truly significant intrinsic upside. As retiring CEO Dr. Ian Kadish stated it in his final chair's letter, good medicine will always be good business. And honestly, Integral Diagnostics' entire strategy is built on that exact premise. If you invest in the best clinical technology and prioritize patient outcomes through earlier disease detection, the financial returns naturally follow. Quality healthcare delivery is the ultimate driver of their shareholder value. So we have to conclude with this provocative thought. As fellow shareholders, when you weigh the risks of that tight 1.8% profit margin against an undeniable structural growth runway, fueled by Medicare regulation and a highly stabilized leadership transition? Is the market dramatically underestimating the durability of Integral Diagnostics post-merger earnings? It is a tension every single investor needs to carefully evaluate. Thank you for joining me for this explainer, and as always, keep your eyes on the data.